Hello and welcome to this video. In this video, I would like to start with the financial analysis, and I would like to start with some very easy ratios with margins and intensities. Another word for intensities is the word cost ratios. For this video, I planned the following. I would like to analyze an income statement with you. I would like to analyze margins, and I would like to analyze intensities and cost ratios. Like with all ratios in financial analysis, margins and intensities can be compared A, to other companies of the same industry, or B, with the same company with the previous year. Of course, comparing with other companies of the same industry gives an insight about the relative, let's say, stability or profitability of this company compared to others. A comparison with itself, with the previous year results, will give an insight if the company has improved or if it has worsened its financial positions. Here again we have our income statement for 2019 of a very large company, and I just want to show the upper part that in an earlier video we called the item by item layer, because in this layer we have an item by item approach. If we sell an individual product, we will earn some revenue on this product, but we will also add some cost of goods sold for this individual product. So with each and every product, both numbers are increasing. Can we now make out of these three numbers, net operating revenues, cost of goods sold, and gross profit, which is the result out of the upper both, can we now make very simple ratios out of these three numbers? Yes, we can. We can calculate an intensity and we can calculate a margin. So what is an intensity? An intensity is defined as the ratio between a cost item and sales. And a margin is defined as the ratio between a result item and sales. So we have one cost item. Cost of goods sold is a cost item. And we have an in-between result, so the gross profit is a result item. And of course we have the denominator sales that we see here. So sales is the denominator of these fractions. Well, let's have a look. For example, we can calculate the cost of goods sold intensity. And the cost of goods sold intensity is defined as the cost of goods sold divided by sales. And in this particular example, we now divide 3,365 by 8,600 So let's grab a pocket calculator, and that is 0.39 or equivalent 39%. So from each euro, or from each dollar in this case, of sales, 39 cents will be spent for the directly attributable cost. So for the cost of goods sold, 39%. And of course, we have an example for a margin. We have the gross margin here. And the gross margin, of course, is defined as the gross profit divided by sales. In this particular example here, we would now have to divide 5,329 by 8,694. Again, using the pocket calculator, we will have 0.61 or 61%. In other words, out of each euro or each dollar in this case, sales or revenue, we will earn some 61% or 61 cents gross margin. Keep in mind that COGS intensity and gross margin always have to add up to 1. Or 100%. Okay, fine. So this is the concept of margins and intensities. And intensity is the ratio between a cost item and sales. That's why it's also called cost ratio. And of course, it is not necessarily cost of goods sold. You can also calculate your own cost definitions. As long as you put them into a relation with sales, it is always a cost ratio or an intensity. There's an E missing. Okay, and a margin. A margin is defined as the ratio of a result item and sales. And I have given 2 examples on that on this page. If we now go into the next layer of our income statement, of course we can calculate the same for selling and general administrative expenses, which is a cost item again. R&D expenses is a cost item again. And operating income is an in-between result that we also called EBIT, earning before interest and tax. So this is a result item. And of course, we divide again by sales given here. So the abbreviation for selling, general, and administrative is SG&A. And the SG&A intensity is accordingly defined as SG&A expenses divided by sales. In this particular example, it would be 2,767 divided by 8,694, and that gives us 0.32, which is equivalent to 32%. So this company, out of €1 or $1 of sales, this company puts 32 cents into selling or general and administrative expenses. Of course, this ratio is an indicator for the overhead of the company. In other words, if in comparison to other companies of the same industry, the selling and general administrative intensity is a lot higher, the company should think about leaner processes and less management. The R&D, research and development intensity gives an insight about how much money is put into research and development of new products, and it is defined as R&D expenses divided by sales. In this particular example, it is 127 divided by 8,694. And using a pocket calculator, this is roughly 0.01 or a very tiny 1%. So seemingly, this company is not very keen in research and development. Typically, old industries like beverages or food or whatsoever have a very low research and development intensity. Industrial firms, especially car producers, have some middle, and high-tech companies like Google, Apple, and so on have a very high research and development intensity. The same is true for biotechs. And of course, now we can calculate the EBIT margin. Attention, this is again a margin, so let's write it like this, EBIT margin. And the EBIT margin is of course defined, that is called, by the way, it is also called operating margin or operative margin. It is defined as EBIT in relation to sales. In this particular case, it would be 2,435 divided by 8,694, and that is 0.28 or 28%. In other words, this company will earn out of each and every euro or dollar they have as sales some 28% as operating income. If we now look into the next layer that we have, which is the financial layer, it doesn't make any sense to divide any of these items by sales, because interest income is not driven by sales, not at all. Interest income is driven by the amount of money invested. Interest expenses is driven by the amount of money lended, and so on and so forth. So we have different ideas how to analyze these items. I would like to make the example with the interest expense, so this one, and with the equity income, so this one. I leave aside the other ones that are typically of not so much importance. First of all, we need to take a look into the balance sheet, because as I just said, the interest expense is driven by the money lended. And the equity income is driven by the money invested in interest in other companies. So where do we find this in the balance sheet? In the balance sheet, we find loans and notes payables, and probably we will pay some interest on that. Current maturities of long-term debt, and of course, the long-term debt. So these are the three numbers we typically would have to pay interest on. For the other number, investments into other companies, we have equity method investments. Equity method investments is the book value of the other company, but revalued. And when we have bought this other company, we have paid more than this. We have paid this plus this one. But the goodwill that we see here is not covered by any book value of the other companies. So it is an intangible asset. We paid more than the book value, so it is not fully covered by book value, and everything that is not covered is shown here under goodwill. So we have to keep in mind this number and this number for our dividends, and this, and this number for our interest. If we now calculate the interest expenses and put this into relation on the book value of debt, we arrive at something that we can call the book interest rate. Interest rate is I think that is clear. Why is it book? Because we see it here in the books. It is not the contracted interest rate, because I would guess that we see many contracts here and they are all mixed. But we see the book interest rate based on the figures that we get from the books. And of course we can define this as interest expense. Divided by debt. And if I say debt, I mean any debt that is interest bearing. Okay, so in this particular case, the interest expenses 245, and the interest-bearing debt, I just go back to the other slide, 10,994, 4,667, and 36,026. So here we have 10,994 plus 4,667 plus 36,026, and that is, oh, that's small, so it is smaller than 0.01, accordingly it is smaller than 1%. That is a very low interest rate. Would be interesting to find out why this interest rate is so very low. This is very untypical, even though we have a very low interest rate outside at the markets. Nevertheless, this one is really low. Probably this is due to the fact that this company is very, very stable, or it's meant to be very stable. Okay, now let's analyze the equity income that we see here, 133. And how can we call that? We can call that return on interest in companies. And let us define that as equity income divided by everything that we have paid for, everything that we had to spend to buy the interest in the company. What was that? Of course, it was equity method investments, 25,954, and we also have paid the goodwill, so 60,764. I just write equity investment plus goodwill. In this particular case, we now have to divide 133 by large numbers, 25,954 plus the goodwill, 60,764. And that is again a very low number, smaller than 0.01 or smaller than 1%. This can already be mean as an indication for problems with those companies that we hold. So, indicator for weak performance of interest in companies. And what follows after a weak performance of those companies, typically we would have to book a write-down, an amortization, an extraordinary amortization. Of those equity holdings. Probably we see here other financial income or loss. We see a loss here. I would guess that this is already an extraordinary amortization. To find out, I would have to take a look into the notes of the financial report, and probably it is written there. If we now go over to the fourth layer of our income statement, the tax layer, again, it doesn't make any sense to divide the income taxes by sales. So keep this in mind, it doesn't make any sense to calculate something like a tax intensity. But we know what drives tax. It's simply the tax base. So we can calculate something like a book tax rate. Which is not the real tax rate, but the rate that we have really paid. And that is defined as income tax divided by income before income tax. So in this particular case, we would now divide 522 by 2,225. And that is 0.23, which is equivalent to 23%. So what we see here is that this company has paid a 23% tax rate. This is a US company. I have no idea what the tax rate, the corporate income tax rate in the US is. But comparing the corporate income tax rate with, let's put it like this, with an arrow pointing in both directions, with a book tax rate, can be an indicator for tax aggressiveness of this company. So how aggressive this company tries to reduce the tax burden. Last but not least, we come to the bottom line result of the income statement, the consolidated or simply the net income. Of course, we can calculate something like a net margin. That is also called the profit margin. And of course, that is defined as the net income divided by sales. So, in this particular case, we would now divide 1,703 by 8,694, and that is, I just wrote this down, 0.195, which is equivalent to 19.5%. So, out of each and every dollar or euro of sales, this company earns some 19.5 cents of net income. But attention, this result must be taken very carefully or very cautiously, because the consolidated net income is not only due to the operating business that we see here, which ends with the operating income, but we also see the financial results here. And the financial results can be positive, they can be negative. So sometimes we see companies that do not earn a single dollar operating income, but earn a lot with investing money. So the consolidated net income is the result of both operating and financial business. And what we all might have learned in our first semesters, it underlies the leverage effect. So, net income is affected by financial results and underlies the leverage effect. In one of the forthcoming videos, I'm going to repeat what the leverage effect is and what the formula for that is. And I will show a better alternative than the net margin. So, to summarize this, I would like to point out that margins and intensities are very good in analyzing the operating income. They are not so good in anything below. I hope you enjoyed this video. Thank you for listening and see you in the next video.